Time now for charting futures. Here's Abigail Doolittle. And Abigail, stocks down sharply, but a different story for some of the commodities.
You know, Romaine, it's such an interesting day because lots of different dynamics going on. The main one that folks are interested in, stocks are lower. And if we take a look at the S&P 500 E-mini futures, take a look at that, down 0.7%, on pace for the worst day in almost 2 months. This on trade risk, the ISM manufacturing slump. But we have growthy commodities higher. Slightly. Take a look at the Bloomberg Commodity Index, up just fractionally. But where we really have some strength here, the energy complex. Crude is up 1.4%. Hopes at OPEC that their a potential output cut could be greater than expected. And natural gas up 2%. I have to think some of that has to do with the snow that we're seeing here in New York. But this could also have to do with the fact that natural gas just suffered the worst November going back to 2001. Not surprisingly, if we take a look at this long-term chart of natural gas, not even going back to 2001, we see this huge range of highs and then lows and highs and lows. Over the longer term, it tells you that traders don't have a lot of certainty for the fundamentals. And right now, natural gas stuck right in the middle of that range, somewhere between, let's call it 2 and 3, not counting that huge spike up to $5. To talk more about what could be ahead for natural gas and how to trade it, Peter Borish of the Quad Group. Thank you so much for joining us always. And that's quite a chart, but we actually have a near-term version of that chart, and it's really hard to decipher in terms of the range. Again, not a lot of certainty, on the part of traders.
Well, I really like this, and I like this market. Sometimes you come on here, and there's like a trade to be done, and there's a lot of technicals. In this case, it's really a fundamental market, right? It's a supply and demand dynamic, and you've seen that over time, right, we are able to get more supply and there's downward pressure on prices. But right now, you're kind of like, hey, if I'm a person, I have to think more fundamental than technical. Are we going down to the $2 level and then really breaking down, or are we going to go back up to the middle of the range, $2.50, $3? And that's a great way to play it. So you have multiple options. Literally talking options. You can say, hey, you know what? I think it's staying here. It's not really doing anything. I can then sell calls. I can sell puts against it and get that income, and it's going to be in the revenue. But if I think it's going to break down, I can do just the opposite. I can then buy that put. And I could also sell that call if I want to have a synthetic future. Or if I think it's going back up to the other, I can do the exact opposite, right? Sell the put and buy the call. This is really important for people when they're discussing markets to think, where is it going to be? Not just on a technical basis, but I need to take into account all the supply and demand dynamics. We know technology is getting better, so we're producing more of it. We also know that there's climate change and average winter temperatures are rising, so that puts downward pressure on prices. At the same time, given the concerns about CO2 emissions, there could be a lot more demand for natural gas. Hence the tug of war, and that's what makes this market one of the most fun markets to trade.
Well, that's great commentary for sure. And you certainly have something up here for everyone. The bulls to buy the the bears that buy the $2 February puts for a break below that complete range. For the bulls, something above 250, or selling each of those. If you had to take a directional stance, just to put you on the spot a little bit here, which way would you be going right now? I guess just on trader's instinct.
I lead towards the downside because I think that our technology is getting better. As I said, we're using less of it. And on the demand side, with Nest and things like that, we're using less of it. So we're supplying more, we use less. That drives prices lower.